That's my
Love it.
Can't get stuff anymore, can you?
Hello and welcome to the Inside Property and Finance podcast. Today we're going to talk about serviced accommodation finance because it's a great strategy. This whole strategy around Airbnb, short-term holiday lets, or booking.com or the contractor market. We can get into those kind of key points and why it's a great strategy and why it's very relevant. But more and more investors are looking at the finance side of things and how they can maximise that. They've probably heard things like getting the commercial valuation against the bricks and mortar and, you know, what's the loan to value in terms of what you can get and a whole bunch of other things too. Now, let's get into that. And we've just been chatting about this pre-recording the podcast because the reality is we're going to have to caveat a lot of things, but let's get into that a little bit more about the whole SA strategy and around that finance.
Do we have to?
It's a bloody minefield. No, one word that popped in my head there, well, two, are what is projection-led lending. So what I mean by that is people might buy a big old property and they might renovate it into apartments. Let's imagine it's 8 self-contained apartments and it's not yet rented out. It's had a history of being a guest house, for example, but the guest house books are pretty low because most guest house owners, as we know, might have took cash and their accounts are kept to a minimum. So projection-led lending is where a lender considers the future income from that asset. And when we started out doing SA, it's a relatively new space as well because it's kind of ballooned since COVID, hasn't it? Since that period. And when we started doing it, lenders looked at the future income and people wanted to know, can I lend against the commercial valuation afterwards? So after it's renovated, you know, the projection-led income, it's the commercial value. And initially, some lenders were saying, yes, we can go to 70% of the commercial valuation and we'll take the projected-led income and we'll do it straight away. But as time's gone by and lenders have started to underwrite more of these cases, it's transpired that really they want to see like hard income coming in for a period of time. And that might be 12 months, it might be 18 months, it could be 2 years, depending on the lender.
3 with some.
So, yeah, with some. But I've been given enough comfort that 18 months, really, to use 18 months as the minimum with the, you know, the more competitive lenders to work off that figure. So they're just things to bear in mind. People want to sort of wring out the towel with a nightly rate, and it might be contractors, it might be holiday makers. That's a factor in all this as well. So, because ideally as an investor, what you want to do is acquire the building, renovate it in a few months, whatever it takes, and then get it rented out straight away, lend against the commercial valuation, go and do it again. But there is a period of time there that has to elapse before you can lend against that commercial valuation.
So let's just touch on the whole commercial valuation point here, because if anyone's listening here and that's not familiar with the strategy, you might be wondering what the hell does that actually mean? Well, in short, if we just break it down into two types of valuations, there's the bricks and mortar valuation, as in how much is that property worth? And if we're buying that building and we're converting it into 8 apartments, as in this example, then what's that building going to be worth, bricks and mortar, once that's all done too? Mm-hmm. And that's going to be 2 different valuations. And lenders, when they are going to be lending initially, you're likely going to be going with a bridge, aren't we? And then, unless you tell me otherwise, because the bridge allows someone to purchase the building, to take it through the renovation, and that's why you need to have the exit finance, which will be one of these lenders who will lend based on either bricks and mortar or the commercial valuation. But what you're saying there, Steve, and this is where a lot of people get caught out, is that you've taken a bridge. You need to make sure that that bridge is over a length of time to allow you to not only buy, renovate it, but then to start having it trading in order to have at least 18 months of trading history to then exit it over on the commercial valuation.
Yeah.
Because the commercial valuation is normally a lot higher than the bricks and mortar valuation because they're treating it like a business in effect.
Exactly. And what they'll look at is, like, one way of doing it is to look at the nightly rate, work out that over the year. They'll apply an occupancy rate, which could be 60, it could be 70%, and then they'll take off, let's say, 25, 30% operating costs. and then that's the net figure that you're left with, and then they'll apply a yield percentage, which could be 10, it could be 12%, and then that gives you the commercial valuation. So like one case we were looking at, the bricks and mortar valuation was 640,000. This is just to give people a bit of a comparison. The commercial valuation, I think, was 905,000, so it's significantly more. And if you can lend 70% against 905, it's much better than 75% against 640. So that's why it's of interest. But like one way you could do it, of course, is to renovate it, get off the bridge quickly, and just lend against the bricks and mortar value and take 75%, and then just sit on that for a couple of years and then switch to a commercial valuation. That's just one strategy.
Yeah, because assume that if you've got 2 years, 3 years of running books against the commercial, property as such, or against the asset itself. In this example of having 8 apartments, it's no longer making assumptions, is it? Because you've got the accuracy there. You've got, well, look at my occupancy rates in the last 3 years. Look at that on average, it's this, and look at my nightly rates and so forth. So it means that it gives the lender who's going to be lending against the commercial valuation a lot more comfort, because less assumptions have been made because they've got accuracy around the books.
Yeah, and if you've got investors on board, which most people do, don't they? They'll take a bridge out for the equity gap. They might take investors on board. It's not all their own funds. Then one way of paying your investors back could be out of the income for that 2-year period, and then you lend against the commercial valuation, and then they can get a capital sum back as well at that point. So it's just trying to think a little bit more creative with it.
Yeah, that's good. Just one thing on the commercial valuation as well is that you guys let me know, because I know they'll caveat this with lenders changing their minds all the time, right? But you can't just go and take a property that can be used as a traditional buy-to-let as such and turn around and try and turn that into getting a commercial valuation. Am I right in saying that when it comes to lenders? Lenders will look at it and go, well, look, it's very different when it's a building that used to be an old bed and breakfast that you've turned it around into 8 apartments in the example we've been using here, or less or more. That's very different to then just taking a random property that would be a traditional buy-to-let that you're now doing SA because there's demand there for it. You're just not getting a commercial valuation in that one.
Yeah, I've had people say to me, I've got this 2-bed apartment, or I've got this 4-bed terraced house. Well, it's like, come on, right? If the lender needs to repossess that property, which is what they look at, isn't it, the worst case scenario, put it on the open market, who's it going to appeal to? Well, Joe Public could buy that. So if it's an investment type property like the ex-guest house and it's 8 self-contained apartments, Joe Public's not really buying that because it's not geared up, it's not set up as a residential home. So it's that type of thing. The other thing to consider is the use class. Yeah. So like, I can't think what the class is in Scotland, but in England and Wales, C3 is residential, C1's commercial. So if it's commercial use class, which it probably will be if it's been an ex-guest house, again, that's not going to Joe Public because it's previously been set up and geared up for, commercial usage. So that's something else to bear in mind.
Yeah, no, it's important to know that as well, because the amount of people who are like working on some commercial multiples, thinking that they're going to be buying something, a traditional residential property, and there's demand for it in terms of being ran as an SA. And then the bricks and mortar values, a couple $100,000, but they're like, I could double the valuation. And I'm like, come on, it's not going to work that way. Don't get caught out. And it's quite exciting, I guess, when you look at this as a strategy, because there's big demand for it, like you just mentioned there, Steve, because of recent years and everything that we've gone through with staycations and the contractor market. Even in the contractor market, there's even though I think it's expensive when people are paying nightly rates, but it's a lot cheaper in comparison to having to put up a whole bunch of people on a hotel.
Oh, yeah. And a lot of guys are happy to share rooms, aren't they? So that, let's say they're paying £80, £90 a night, 2 in a room like that, rather than paying £120, £150 plus in hotels. And I've stayed in, as you have, Paul, as we come up to Glasgow, we stayed in many a hotel, and there's contractors there that are paying £150 a night plus, and you think, clearly there's a market for this, and I'm very much in favour of SA. We just need to think, especially if we've got investors on board, just need to think about the whole process and exiting out of that. What's the best way to do this, to pay our investors back, or to pay them out of the income along the way if we can't pay them their capital sum with interest back straight away.
Yeah, absolutely.
I think it's just people being realistic, isn't it? You know, we see the inquiry, obviously the embryonic stage of, I'm going to get this property, I'm going to convert it, as you said, I'm going to have 10 rooms, they're all paying me X, so I'm going to get a commercial value of Y. And before we even ask them how they got to that commercial valuation, we can probably answer the question. They've times their annual rent by 10, because that's what everyone in the industry says a commercial value is based on. So, you know, I've got to be careful, because it frustrates me watching the guys put SA finance together, because it is complex. You've got to know what you're doing. It's very time consuming. Now, that's not me for 1 minute saying SA is a load of rubbish. It's not, because as you've just alluded to, your yields can be massive. There's high demand in certain areas. I think what we are trying to say is, yes, you can get commercial valuations, but the misconception is it's not 10 times annual. It's what that valuer still thinks a commercial valuation is. Will the valuer even give a commercial valuation? So I'm going through all the negatives now, but you know, I'm trying to balance it with the positives. We've had lenders, and this is where, when they're trying to get the commercial valuation from the get-go without the trading record Steve alludes to, where we get them, the lender to agree to a commercial valuation. They instruct it on that basis. The valuer does the valuation on that basis, which doesn't always happen, even though the instruction has been quite clear. But then lenders can often turn around and say, well, now we've had a look at the whole case, that's 70%. We're still going to lend against a commercial valuation, but we're now going to lend at 50% because we just feel the risk mitigates us doing that. And then you think, hold on a minute, you see that 50% of the 900? It's exactly the same as the 75% of the 640, but we're now on much higher interest rates. You'd have been better with the normal form of finance. So, you know, without being overly negative, it's just trying to say to people, don't assume. Don't assume because you've read it on the internet, or, you know, you've heard that 10 times rent is what a commercial valuation will come out at. Valuations are tricky things at the best of times. Commercial ones are another level of trickiness, aren't they? You just got to make sure that you've got your fallback option, and either, as you allude to, make sure your bridge facility is going to accommodate acquiring this track record, so you've got a better chance of commercial valuation lending. Or as Steve said, maybe accept that your exit finance first time around is going to be more of a standard buy-to-let product. And there's plenty of lenders there who will say, we'll allow you to do it on SA, but we're going to lend on bricks and mortar and on what the normal rental value would be. So, you know, there's loads of options to do that. Potentially, depending on the nature of it, we've also got holiday lets that can, lenders that can give you the right type of exit finance. And then maybe, you know, Steve says 2 years down the line, got the track record, we can get the commercial valuation, we can sweat the asset that little bit more, get the money back out again, and you know, great. Let's say the message is, just be careful about this day one refinance situation. Don't assume this 10 times income is just going to be child's play. It's a difficult process.
Yeah, and we need to take a structures finance approach to SAs. Like, if you've got your own funds, then great, you know. But for many people who are trying to leverage and do multiple of these here, then using private investment, you know, investor money. Yeah. And here's another thing as well. There's many investors out there, and because it's a commercial asset as such, they can leverage SaaS pensions as well, which is great. Yeah. You know, so you can start to see how a lot of people would be keen to come in on this. Yeah. And use, like, I've used my own SaaS to invest in a serviced accommodation, right? Yeah. So from that point of view, I've got first-hand experience of doing that. And the best part about that is that not only is my SaaS benefiting from a return there as well, I have a side agreement that also gets me funds from that too, and being involved in that project. And of course, once I eventually get the commercial valuation from that, then that uplift comes, and if we decide to sell that off or to refinance, you know, the SaaS benefits, I personally benefit, you know. So there's many people out there that with a little bit more work in finding the right private investors, those that can fund and get involved, you know, there's an appetite for investors to get involved in those types of projects as well, because they know that, look, if you've done your due diligence, you know the occupancy rates, they just know that they'll get their money back inside a period of time, and those private investors are happy for 2 years, 3 years, sometimes longer, because they're getting, as we've said here, they're getting paid from the income that's coming in. Then the investor himself might mean that their income will be restricted or not getting as much because the income that's coming in is covering that private investment and everything else. But think about it, like if you've got a cracking SA here, that's only going to be a few years until the investors all paid back, got their capital, the debt's all been serviced, and then you'll be able to leverage that commercial finance, get that commercial valuation because you've got the track record, you've got the books, and you're left with the assets, and then those JV partners and private investment have been paid off. So it's just almost a little bit of a waiting game, you know, if you don't have your own funds. But if imagine you just had one of those a year.
Oh.
In 3 years' time, one gets cleared off, and then, you know, and you're starting to get an income there. The second one gets cleared off the year after. Before you know it, you're going to have likely tens of thousands of net income every month.
Yeah.
You know, so that's the exciting thing to look forward to, having a little bit of a longer approach to viewing your essays.
Yeah, no, massively important. Two things stand out in my mind as you mentioned that, Paul. It's that the SAS pension, there's a lot of people there with pensions that if they've not created a SAS, that then they can do, can't they? They can transfer their existing pension into a SAS, and then they can invest in commercial property. And then the usage class of that asset. So instead of looking like most people do for a residential usage class and treating that as your SA, look for things a little bit out of the norm. I mean, who was it that went bust the other week? Was it Wilco's? You know, look at the commercial assets that are left behind. It'll be in England and Wales, a C1 usage class, or maybe slightly different, but something that a SAS pension can invest in. And it's just thinking a little bit more creatively and getting your investors to buy into projects like that.
Absolutely.
Please make sure you've got someone who knows how SASs work alongside you. That's one thing we'll say. We've had too many real disasters of people who think they can do it all themselves, but you deal with a guy, Paul Barry, don't you?
Yeah, so Paul's you know, an expert in all things SASs, and he helps me with how to structure things too. And you're right, because it's important, because when you are investing your SAS money in your pension, you know, like, you need to keep in mind that you've got administrators that are reviewing and looking at that, making sure you're doing the right things. So, you know, that's always important.
It really affects the borrowing. Someone who knows what they're doing, as opposed to people who don't. It really affects what borrowing how easy it goes together. Does it get done on time? I don't want to labour the point, but if you don't really know what you're doing, find someone who does. It's very important. And
just on that point, like, if you're looking for an intro to discuss all things pension-wise and utilising SAS, then reach out to expressmortgages.co.uk. And if you speak to any of the team, you can mention you heard this on this podcast, and we'll make that introduction directly to Paul. Another Paul. There's too many Pauls, all right? So he's a specialist. He works with all my pensions as well in terms of my own personal SAS. He works with a lot of my clients too. So just reach out to expressmortgages.co.uk, let the team know, and they'll make an email introduction for you to help you on that front. So sorry, carry on, Paul.
And yeah, I was just going to point out now more on the positive side of SA finance, not just the fact that when that asset has got a year and a half, 2 years books behind it, but then the individual has got that principal experience behind them. So the next time you want to sweat that asset, the lenders might say, do you know what, we see your track record with that property. We're going to be a little bit more lenient with you on the second one. We only want a year's books on that one. And if you build up that relationship and that track record, there's nothing to say that those type of lenders, because we've seen it, where they go a little bit outside of normal criteria for existing customers or experienced people. And it might be to say, when you've got 3 or 4 of these behind you, they might be actually quite willing to go day one commercial valuation if you've got that proven track record. So that track, I'm saying, is that track record is not just important for that property.
Yeah.
It's important for you as an individual. And yeah, finance does get a whole heap easier when lenders have seen you perform once, twice, 3, 4, 5 times.
Yeah. That's good. I guess it's the same with all things finance, isn't it? Like, when you start out, you've got to do what you've got to do, right? You know, so joint venture with people, you know, leverage different funding and pay the rates, and you know, and so forth. But the more that you can get that track record and build it up, you're always going to be a lot more favourable to funders, aren't they? They want to lend to you because you've got that track record. So that's something to look forward to. And I guess if we bring this to a close, it's a forever evolving finance product, isn't it? You know? And
I think it'll get easier as lenders get their heads around it. Same with buy-to-let. I mean, that's how all we are. Well, me maybe, I don't know. Been in the industry long enough to remember when we had one or two buy-to-let lenders and you couldn't get much and the rates were up here, and the more lenders thought, this is good, the more competition, cheaper rates, higher lending, easier lending, set criteria, no fighting with underwriters over, on this deal I'm going to do that, on that deal I'm going to do that. And I think that will come to SA. It's already a lot better than it was 2 or 3 years ago. You said that to some fund, SA, what's SA? Yeah, service accommodation. Oh, is that the thing when it's a holiday let but not a holiday? And this is lenders, but we're way past that now. So I do think it'll get easier and more standardised, and with that, underwriting's a whole heap easier.
Yeah, it's a phenomenal strategy, especially for cash flow. When done right as well, it can set you up. You know, if you think about it, one buy-to-let, you know, makes you money if done right. And it might take the equivalent of 4 or 5 buy-to-lets net income compared to one SA, the right type of SA, especially if you can get that commercial valuation. It's going to open up the whole different game as well. So this is why, for many, it's a great strategy. And again, based on everything I keep on saying, having those finance people, such as Express Mortgages, being able to coach and support you through that whole process, reach out to them. Because through having that conversation, we'll be able to see what options are going to be available for you to give you more confidence when you go out there to do more deals. So head over to expressmortgages.co.uk. And as always, pop in to the comments any questions you've got. We'll keep an eye on to go in there and respond and answer to your questions. And of course, make sure you subscribe to the podcast too. So all the best. I'll catch up with you guys soon. Cheers.